And we just name-dropped Dropbox, the big earnings mover of the morning. Deirdre Bosa is in San Francisco with more on that quarter. Deirdre.
Hey, good morning, John. Well, shares, they're now trading well above its IPO price of $21, nearly 2 years after that debut. And put simply, guys, things don't look quite so bad. Last night, the company beat expectations and showed investors that it can return some money with a $600 million share buyback while also hitting a key milestone. Have a listen.
By the end of this year, our goal is to become a profitable business on a GAAP basis. This orientation also extends beyond 2020. Longer term, we plan to drive accelerated margin expansion as we continue to innovate and methodically extend our platform into new markets.
Now, yesterday, we told you about short seller Spruce Point Capital, which has called Dropbox a, quote, melting ice cube. But with shares up more than 20% today, this short seller is likely licking its wounds, so it doesn't disclose its position. Still, though, guys, I want to underline that questions still remain. Drew Houston himself admitted that there is still work to do. Over the longer term, share performance is ugly, and the company is adding paid users at a slower pace. Now, Dropbox has, of course, been plagued by worries over user conversion and competing in a very crowded cloud space as it tries to move up market and capture more of that enterprise space. Now, that puts it up against behemoths like Google and Microsoft. And on the consumer side, there's Apple and Amazon. So this quarter likely isn't enough to alleviate all of those concerns. Jefferies raising its price target, but says the lack of growth catalysts keep them at hold. RBC liked the buyback and the margin story, but lowered its price target by $2. Bank of America maintained its buy and said Dropbox is orienting investors towards a lower growth, faster margin expansion scenario. Back to you guys.
Yeah, Deirdre, I've always got to look at Dropbox next to Box, which went public a lot earlier, has a lot of similarities in that, it started more of a freemium consumer play, then moved into enterprise. It seems like in this quarter, a lot of the upward move is based on the plan for profitability and the buyback, kind of that discipline play. Other than that, are there differences that you see between Dropbox and Box, how they're messaging to the street and what their strategies are?
Well, I think both companies would say that they're more of a collaboration tool now, right? This is sort of the hot space to be. That's where you see Zoom and Slack operate, and Dropbox has this new desktop app where it's partnering with Zoom and Slack. So I think that's how it's trying to differentiate itself, but they're both trying to move more into this enterprise space. And I think what's interesting, too, is we talked about the short sellers looking at Dropbox. You've seen activist investors go after Box. So clearly, there are folks out there who think that there's more value to capitalize on. But when it comes to Dropbox, this sort of slower growth story, larger margin expansion, makes you wonder if it deserves the sort of premium valuation that some of the other companies in this very hot SaaS space are able to take. And so far, certainly, it hasn't kept up with some of those other, PE ratios.